Everyone, this is Jeff Foley with Paladin Financial. Thank you for tuning in to our quarterly client educational webinar, Tax Smart 2026, Keep More of What You Earn. So if you haven't gotten the memo, we are in the middle of tax season and a great opportunity to talk about some changes that have occurred over the last year and some planning opportunities that you have for 2026. Before we get into today's presentation, if I could ask a favor of everyone. Last year in the fall, we had a good surprise. We were contacted by White Bear Lake magazine to let us know that we had won the Best of Financial Services in their magazine for 2025. So we didn't know that was a thing, but we're asking your help. If you wouldn't mind, please cast a vote. You can see on the screen there, whitebearlakemag.com. We'd really appreciate that. Winning that again would be a very big compliment to us and also give us an opportunity to serve more people in the community. So that's my ask of you if you don't mind. As we talk about today, we're going to talk about tax planning, and what you see on the screen is what we call the Paladin plan. So for all of you that are working with us, this is what we're doing behind the scenes to make sure that you have a well thought through integrated plan. If you look on the right, we call this the 4 pillars. So you have your financial, tax, estate, and health plan. We want to make sure that those are all working well together. So as we talk about today in tax planning, we're going to address that piece of it, but that also has a big impact on your financial plan and vice versa. So we want to make sure those are well thought through for you. As we talk about your tax plan, so one of those 4 pillars, there's 3 high-level things I want you to consider. It's number 1, be proactive with your taxes that you pay in your tax plan. A lot of the world is very reactive when it comes to taxes. We want to help you to be proactive and take advantage of some planning opportunities. I like to say that a low tax year is a terrible thing to waste because we are of the belief that taxes are going up over time, and for a lot of clients, if you have a Social Security that you're receiving, a pension that you're receiving, those increase over time, and you have required minimum distributions that we'll talk about in a little bit, those are going up as well. It can be better for you to get those taxes out of the way now and not have to pay those later. And third, again, we want to make sure that tax plan is coordinated with the other pieces of your Paladin plan. So some challenges with the tax industry in general. If you look at that industry, a lot of people are retiring, not as many new people are coming into the tax preparation industry. So you have only so many people. You're seeing costs increase. You're seeing some service challenges because they only have so many hours in the day. And again, that industry oftentimes is very reactive and not looking at the long term. And that's not a knock against CPAs or tax preparers, but a lot of times their focus is on how do I save you as much in taxes this year? Whereas we want to zoom out and look at your full Paladin plan and project out what your income and your investments are going to do over time, and with that, be more proactive with your tax plan. So making sure, again, those pieces are coordinated. So if you haven't gotten the memo, we did launch for the 2025 tax season Paladin Tax Services, so we can now prepare your taxes, and the team that you know and hopefully love at Paladin Financial is supporting you with that as well. And we can do this for individuals, families, and if you have a business as well, prepare your taxes. And again, make sure those are integrated with your financial plan. So we're both doing tax planning on the financial side and tax preparation. So if you're interested in that, we'll talk a little bit more. You can reach out to us and we can put together a quote for you for your 2025 tax return and let you know what that would look like. So some things that we're going to go through today, we're going to talk about some of the changes that kicked in with the One Big Beautiful Bill Act that passed July 4th of 2025. So as you prepare for your 2025 taxes, you want to make sure you're aware of some of those changes that occurred, some opportunities, and that might, again, create some opportunity for you also in 2026 that we'll talk about some new developments there. Opportunities for long-term proactive tax planning, again, is not trying to pay the least amount in taxes now, but over your lifetime. And we're going to show you an example of what that would look like for you. The One Big Beautiful Bill, there's a lot that was packed into that 900+ page bill. So I'm not going to go through all of that, but a couple high-level things we'll talk about. Tip income. If you do receive tip income from an industry that's normally receiving tips, you can deduct up to $25,000 of that income. Overtime pay up to $12,500 per person, and that is only for the time and a half, for example. So if you get time and a half, it's the half that you're able to deduct. Car loan interest, if you're purchasing a brand new US assembled car you can deduct up to $10,000 of that loan interest. So there's very strict requirements on that you want to be aware of. And then a big one for many of the people watching today is the new enhanced senior deduction, where each person receives $6,000 and then you get phased out of that as your income increases. So that creates some planning opportunities. You also want to be aware of anything in the One Big Beautiful Bill. Most things have an income phase out that you want to be mindful of as you take advantage of these opportunities. One, I'll talk briefly about new Trump accounts have gotten a lot of play in the media, but I think for most people, a 529 plan is a better long-term opportunity outside of the one-time government seed credit that you get in establishing that account. So if you're interested in learning more about that, please give us a call. We can dive into that. For a lot of our clients, again, the 529 plan is going to be a better opportunity and offers tax-free income. Charitable deduction, one of the changes that occurred with the One Big Beautiful Bill is if you're a non-itemizer, so in other words, you're doing the standard deduction, you can now still use the standard deduction and deduct up to $1,000 per person for charitable donations. So you want to keep track of your receipts and donations that you've done throughout the year and be able to pick up that additional income reduction. If you are an itemizer, there's a new floor that kicks in with that you see on the screen that based on your income, you want to be aware of the limitations there. And there is no income phase out on this charitable deduction opportunity, which is nice. Some other things to think about, some strategies in conjunction with the One Big Beautiful Bill is look at, can you accelerate income into those years that you see on the screen, 2025 through 2028? Or adjust out of that? Can you increase your expenses during that time frame? So a lot of that's more relevant if you're a business owner and you're looking at incurring some large expenses, but income, depending on when you're retiring, you might have some opportunities to adjust your income from year to year. So starting today, so some of these changes kicked in with 2025, some of these with 2026. So make sure you're looking at that for both years. And to take advantage of these, you want to make sure that you're tracking those things. So if you receive tip income, know what that is, be able to document that, overtime income, loan documents if you're taking advantage of that, interest deduction. Some other opportunities are bunching deductions. So what that refers to is, let's say you're deducting or you're giving to charity a certain dollar amount each year. Rather than doing that every year, you could compare the numbers and see, does it make sense for me to do 2 years worth of contributions in a particular year? And that might enable me to get above that standard deduction limit and be able to itemize and reduce my income further. And then the following year, you're not giving anything to that charity. So there's some pros and cons with that. But depending on the amount that you're giving to charities, that could be a big tax savings for you. You also have qualified charitable distributions. So once you're age 70 and a half, you have the ability to give money directly to charities. That doesn't hit your income tax return, and that amount also counts towards your required minimum distributions if you have those as well. And we're going to talk about RMDs here in a moment. If you are still working, does an HSA make sense for you? So if you're on a high deductible health insurance plan, you could pair that with an HSA and you're able to put money in on a pre-tax basis. So get a tax deduction. That money grows tax deferred and comes out income tax free as well. Depending on the mechanics of your health needs and your income, that can be a good opportunity for you. If you have questions on that, we can help you to evaluate that as well. Some other strategies to look at is we're very big on processes and have a good process for how you prepare your taxes if you're doing this on your own. What documents do you need to gather, keeping track of any taxable events or deductions that occurred throughout the year, and also working over time to try to simplify your plan. So if you have investment accounts at multiple institutions, it might be good to pare that down, number one, so you can keep a better eye on things, but also decreases the chance of errors and make sure that your financial plan is well coordinated. Review your Social Security statement. So if you are still employed, I would suggest print off a recent copy of your Social Security statement and put that in your tax return folder. And each spring, when you start to prepare information for your taxes for that year, pull out that Social Security statement, and that's going to be your reminder to log into your Social Security account and check to make sure that your employer recorded your earnings properly. Because if you wait 15, 20 years before you file for Social Security, you're not going to know what you made necessarily in income in 2025. So look at that each year, make sure that information is accurate. A couple other planning opportunities that relate specifically to brokerage accounts. So if you have an individual investment account, joint account, a trust account, you can take advantage of two techniques called tax loss harvesting, and the second one is simply using long-term capital gains, which are taxed at lower rates typically than ordinary income. So as we work with you in our financial planning process, if you have those types of monies, we are using those techniques where applicable to make sure that you can reduce your tax bill. Explaining both of those a little longer for today's purposes, but those are an important strategy to look at in your plan. If you are still working, should you be putting money in on a pre-tax or a Roth basis? And the answer to that can change each year, depending on your income and other deductions and opportunities. But again, I want to challenge the convention of it's not necessarily a good thing to lower your taxes in a particular year. We want to look at the big picture and lower your overall lifetime tax bill. So it might make sense to contribute more to Roth, depending on your situation, versus the pre-tax. But that's something we look at for each and every one of you to see what's going to be the best opportunity for you. And the other one we're going to spend more time on here today is talking about Roth conversions and what those are and how those work. So as we get into discussing Roth conversions, we're going to talk a little bit about buckets of money here. So high level, you have three types of assets. You have taxable money, so that creates taxable cash flows. So that would be like a brokerage account, joint investment account, a trust account, your savings account, a CD. Those all create taxable events throughout the year. Tax deferred assets, that's going to be money like a traditional IRA, traditional 401k, TSP if you're a federal worker, Minnesota deferred compensation. So that's money that you got a tax deduction putting into that bucket. It grows tax deferred, and then it comes out as taxable income later. For most people, that's the biggest bucket, and this is also the one that you have required minimum distributions. When you get to age 73 or 75, depending on when you're born, the IRS says, hey, you've got to kick some of this money out of that bucket, and that's going to increase your taxable income. And then finally, you have tax-free assets, so that's going to be your Roth money. HSA money would fall into that category as well. And the other more common example is if you have a tax-deferred cash value life insurance policy, if you take money out of that properly, that can also come out income tax-free. So with Roth conversions, the idea we're going to look at is moving money from the tax-deferred bucket on the left to tax-free on the right. And that is a process called Roth conversion. So you're taking that pre-tax money and saying, hey, I want to pay the taxes on some of that now and move that into my Roth. That's going to increase your taxable income in a given year, but then you don't have to pay taxes on any of that money later on down the road. You also, with the Roth account, do not have any required minimum distributions. So how does this work, and why would you consider doing this? So we met with a client here recently. It was actually within the last week, and his tax person had suggested, hey, you shouldn't be doing Roth conversions. Why are you proactively paying taxes if you do not need to? And that's an example of looking at one by one that each year your individual taxable events throughout the year versus a long-term picture. So I'm going to walk you through an actual example of a client that we work with where it does make sense for them to proactively pay taxes now. Key to this is, do you think taxes are going up or down in the future? I mentioned earlier, we think that they are going to go up over time. If you look at the federal deficit and the challenges the government has from an income and expense perspective, we think taxes are going to go up in the future, but that's a question for you to consider. If you think taxes are going down, a Roth conversion might not make sense for you. But we also want to look at your taxable income. So if your income is here and over time with Social Security increasing, pension increasing, required minimum distributions kicking in, we can look out down the road and see what might my taxable income be later. So if you have higher taxable income, you're paying more in taxes, but secondly, that's going to trigger more of your Social Security income to be taxable as well. Side note, Roth conversions are not a guaranteed win because we do not know for sure what is going to happen with taxes in the future. Who knows? Maybe they'll do away with the tax system and we don't need to worry about any of this, but I'm not holding my breath on that. So this is an example of a client that we work with who's 67 this year, and you can see on the screen a projection of his income over time. That income flows represents Social Security and pension income increasing each year with cost of living adjustment. You see at age 73, that's when his required minimum distributions kick in. So it's an estimate of about $24,000 more in taxable income that he will have when he wakes up at age 73. So that's going to increase the amount that he owes in income taxes. So that represents a 32% increase in his income. So that's an example. Now, if you look at his taxable income today, compare that to down the road, maybe it makes sense to get some of that out of the way now before that income increases. So that's something we can use Roth conversions as a tool to lower that future tax bill. So as an example, if we did $30,000 of Roth conversions each year before he reaches age 73, that's going to get some of the taxes out of the way now so that he's paying less in the future. So if you look at that red circle there in his situation, modeling that out, that's going to add over $700,000 in value to himself. But that's also, if he doesn't use that money in retirement, that's also going to increase the tax-free income that his heirs would receive as well. If we zoom in and look at this further, what you see on the screen are the tax brackets. So we can look at tax bracket planning. What bracket do we want to stay within? We want to be aware of Medicare surcharges that we'll talk about here in a moment. But in his situation, doing the Roth conversion saves him a little bit in taxes over his lifetime. It's about $33,000, but you see the overall value was an increase of over $700,000. So that's looking at paying the taxes now to not have to pay the taxes later. On Roth money, once you get the taxes out of the way, that bucket grows over time and you can pull that out income tax free. So some things to think about with Roth conversions is look at what your taxable income and your bracket is today. So you saw in that example, we can see his income increasing over time. For a lot of people that have done a good job of saving pre-tax money, they see a spike in income once they get out to R&D age. And then we can look at each year, does it make sense to convert and how much? And know what that actual cost in a given year is. So with that, if we're converting in our example $30,000 in a given year, we can show here's what that's going to cost you in federal and state taxes now and set aside some money for that. Be aware of Aunt Irma. So that's where you get Medicare Part B and D premium increases if you cross certain income thresholds. So we can be mindful of that in our planning process. And again, as I mentioned, this gentleman's example, if legacy is a goal for you, look at your tax bracket now versus what your heirs would receive if you pass away and they receive an IRA and they have to pay that money out over a 10-year period of time. That is also going to cause their taxable income to increase. So if you could get the taxes out of the way at 18%, for example, and they're in a 25% bracket later on down the road, you save your family some money from a tax perspective. So those are some things to think about with Roth conversions. There's a lot of moving parts with that. We use a couple different planning softwares to evaluate each and every one of your situation to see, do Roth conversions make sense for you and how might that look over time? There's so many different strategies that go along with that as well. So our goal is to help you to make 2026 your most tax efficient year yet. So we're not trying to save the most in taxes again in a given year, but over your lifetime. If you would like our help in preparing your taxes, you can email us at info@paladinfinancial.com and just say I'm interested in Paladin Tax Services, and we'll follow up with you with a quote on what that would be. You can also visit our website. You see the URL on the screen there and learn a little bit more about our tax preparation services. Another thing that we're putting together for anyone that we're doing their taxes is a personalized tax return summary. This is very helpful for you to have a better understanding of what you're paying in taxes, how the tax world works for your situation. Are there any deductions or credits that maybe you were a little bit over the line and missed out on some opportunities, and we can do some long-term planning, and any recommendations we'd have for you to lower your lifelong tax bill. So some next steps, again, if you're interested in us preparing taxes for you, send us an email as you prepare your 2025 taxes. If you're doing this on your own, look at the One Big Beautiful Bill, and are there any changes there that you want to make sure you're incorporating into your tax plan for 25? And also looking forward with 2026, can we be proactive and lower your taxes long term? Again, please, if you don't mind, please vote for us on the White Bear Lake Magazine Best Of. You can see the website on the screen there, or you can Google that. We would really appreciate that. A couple of save the dates items for our clients coming up. If you haven't received the invitations on this or seen those, let us know. But we have March 25th, our client education event coming up, and that's going to be at the Vadnais Heights Commons. And we're going to talk about alternative investments, which is a big term. There's a lot to unpack with that. AI, and how are those things incorporated into investments and the financial community. We also have e-cycling, so you can bring in old electronics, and we'll have a service there that we're renting where you can bring in old laptops, phones, things like that, and they'll destroy those for you and get those recycled if appropriate. May 14th, our quarterly Women of Wealth event. So women only, that's going to be pickleball. We have an instructor that's going to be at Smash Park in Roseville. So hope that you can make those dates for us. And as always, if you have any questions, feel free to give us a call, whether it's about taxes or anything else going on in the world. We really appreciate the opportunity to serve you. We're here when you need us. Give us a call and have a great day. Thank you. We appreciate the opportunity to serve you. We're here when you need us. Give us a call and have a great day. Thank you.